There's a lot to digest here when it comes to renewed market volatility, especially with today's minute pullback for the time being. And here to answer all of that with us is our first guest today, our market savant here in Fundstrat Global Advisors, managing partner and head of research, Tom Lee. And Tom, I love having you on the show, obviously, because when we talk about this, you were one of those analysts that called that March sell-off the bottom perfectly earlier this year when the sell-off was in full force. And now you have a new line in the sand here to watch. And every time that happens, obviously my ears perk up. You drew it at about 32.44 on the S&P 500, saying that that's the level where a lot of investors were pricing in the worst of what's to come. We closed right above that level last week. So talk to me about why that's the key level to watch in your eyes and where we go from here.
Yeah, thanks, Zach. Stocks had a great run since March, but the next 36 days, there's a really important event risk on the horizon, which is the election. So I think markets are really nervous into those 36 days. And one of the things that we have to think about is, when does nervousness price in the worst is yet to come? Like, when do you think the worst is priced in? And we said from June to the August highs, if you give up 2/3 of those gains, which is also a Fibonacci 61.8% of the gains, that would be 32.24. So we think that that's when you start to price in the worst, because you've given up 2/3 of the rally that we've had since June. And I think the world is better than it was since June. So that's where we would start to put capital work. And it looks like that line in the sand's been holding, because it sort of played with it last week and we've closed above it.
Yeah, and I mean, from there, you move up the Fibonacci retracement levels here, and you say the next key level to watch would be 33.63. Talk to me about why that matters here. And again, we're talking about something that maybe even some investors aren't necessarily in agreement with you in viewing this as, just kind of a correction sell-off to be looking at here. Some people might say it's the beginning of something more serious when we think about what happened back in March and when cases really started to rise. So why are you so sure that that's all we're dealing with here relative to what we saw back in March?
Yeah, it's a good question. I mean, the future's uncertain, so I can't say I know what will happen in 3 months, either on the disease or the economy or markets. But I do have a good sense of the probabilities and the kind of risk reward. I think stocks are not in a downtrend because, number one, there's still $4.3 trillion of cash on the sidelines. I don't think in the history of any financial market in the world do you ever have a top when there's 20% of the equity market sitting in cash. Investor cash, that's excluding the private equity cash, the record cash held by corporates too. So you got tons of dry powder. People are bearish, I can tell from our own client surveys, and I can tell by looking at the NDX futures, which is the most record short in 14 years, and I look at AEI sentiment. You never have a top when people are bearish. And then on the disease, it's still a very scary disease, and the economy's in a depression. But one of the things that we've started to wonder is are we starting to overreact to cases because, it's really going to matter if the cases are severe. I mean, for instance, we've been writing about how in colleges there have been almost no hospitalizations. And if you look at the number of new tests, because tests hit almost a record for a Monday yesterday, those incremental tests of 230,000 or 43% more tests only found another 1,200 cases in the US. So it's not like, so I don't know. On COVID, I'm still very concerned, but I think the market's not in a downtrend.
Yeah, that's the biggest question. And I know that you're not a doctor, and you've stressed that in both your client notes as well as when we've had you on the show, and that's fair. But you have been doing a good amount of research in terms of compiling the data around this, and even talking to the researchers behind the IHME model here when we think about what the White House even looks at in terms of how bad this could get in the winter. But I would assume, I mean, when we talk about cases rising, that's a fact that a lot of medical experts have been preparing for and saying the nation should be preparing for quite some time. But in terms of the response to it, as you highlight there, I mean, we have seen cases rise maybe, but there's a lag between that, hospitalizations and deaths here. But as you pointed out on the college front, it does seem that a lot of the outcomes this time around tied to that rise in cases has not necessarily hit in terms of deaths and hospitalizations the same way it had in the past. So, I mean, when we think about maybe lockdown risks, because that's, again, the most direct tie back to the economy and what we've seen on the underlying economic data, we've heard from the president as well as Larry Kudlow saying that that's not an option on the table. We see what's happening in Florida. Ron DeSantis there saying that he wants to open businesses back up. So, I mean, when it comes to the appetite for lockdown again, how does that play into maybe what you expect to see play out in Q4?
Yeah. Well, it's certainly added to uncertainty. Colleges, the one thing I would say is, colleges were 15% of cases in first week of September, dropped to 9%. So colleges, despite people back to school, it's not causing a super spreader exponential growth in wave. It's almost like it's petering out in colleges, shockingly. And Florida, yeah, we'll know in 2 weeks whether or not that was good policy. But I think that it's correct to say we are now at the point where policy has to determine economic carnage against coronavirus because, as we get into winter in the northern states of the U.S., it's going to be pretty catastrophic for a lot of businesses to stay closed. And so, it's a tough policy decision to be at. And then until we have a vaccine or therapeutic, I don't envy anyone having to make those decisions.
Well, let's look a little bit farther out on the timeline here too, because predicting what's going to happen in the short term is always pretty tough to do. But beyond the election and looking into 2021, maybe even year end, I mean, your year end price target is 35.25 on the S&P 500. Goldman Sachs out with their median price target here in a couple different scenarios tied around the election at 3,600. And their mid-year target for 2021 comes in a couple different scenarios here. 4,000 if they get a divided Congress, 3,800 they say if we get a Democratic sweep. I mean, when you look at it and where we might be mid-year next year, assuming we move forward in this progress we're seeing on the vaccine front, and all the cash you've talked about sitting on the sidelines, I mean, are you in a similar view that we will be there in mid-year 2021? And where do you see the opportunity still here if you're telling investors now is the time?
Yeah, I think they're directionally correct. I mean, we're in a new expansion. I think economic policies between Trump and Biden will look very similar, with the exception maybe higher taxes under Biden. And if the economy isn't going to be harmed by either, then I think that's going to matter more in 2021. And do I think that this virus is going to cripple the U.S. permanently? There's no way. The U.S. is a dynamic economy. I think people underestimate that. People start businesses, and this business closure thing is terrifying and sad, and all the loss of employment. But it's going to get people to be innovative and start new businesses. So, in the short run, it's very scary. But in the 2021 timeframe, I'm very optimistic.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.